Zach, how you doing, man? Good to see you.
Good to see you too, Peter. It always feels like it's been way too long when we talk to each other on a podcast every 6 months or so because we used to hang out in person at least once a quarter. And it seems like we're almost on the other side, though. Like, I don't
Yeah.
know how things are in the UK, but it feels like we're, a couple months away now in the US from just all hell breaking loose and everybody being vaccinated and starting to party again.
Well, at least I think it's about a third of our country's been vaccinated now. I'm due for a vaccination if I want to take it within the next month, and I'm going to take it because I want to get on a plane and come out to New York. As you know, I used to be there every 2 to 3 months. We'd always hang out, and we haven't caught up properly in ages, and I'm missing that, and I'm missing the conferences and the events. So hopefully soon, man. And I think we're way ahead of the rest of Europe, which is a bit of a shit show. So yeah, some of the Bitcoiners won't like it, but I am taking a vaccine. I'm going to take all the vaccines in every arm and limb.
That's my strategy as well. What do you think is the first event you're going to be able to go to? Are you going to go to that Bitcoin Miami?
Definitely gonna. I'm like, worst case with that one, I will go because the problem is it's the US letting people in from the UK, but they're letting people in from countries that we can travel to. Well, we will be able to travel to, should I say? So if I have to go somewhere for 2 weeks beforehand, I will. But I mean, I wanted to get out to Austin in April, but I don't think that's going to happen. I think Miami would be the first one, and I think we can all go mental. Are you going to be there?
I'm still on the fence. It depends a little bit on wife and kids' summer schedule, whether or not I'll be able to go. But there will definitely be a handful of people from the BlockFi team. It's just a question of whether or not I'm able to make the trip.
Well, if not, I mean, I'll try and part of the trip to come and see you, man. It'd be good to see you. Grab a steak, catch up. We got a congratulations to you guys, right? Well, we'll come to that. You can tell us about that towards the end, actually. Let's start with, why does everybody hate BlockFi? Well, not everyone. I love BlockFi, but yeah, you split people, dude. Like, I obviously get a load of people give me a lot of hassle and a lot of stress and shout at me for having BlockFi, and I'm like, well, I've been with them for 40 months as an actual customer, no issues, trust you. Yeah, it seems to be like there's this group of people who just wants to come at you all the time. What do you think's going on there, dude?
Yeah, I mean, look, I think a lot of things that ultimately end up being very successful, and Bitcoin, frankly, is one of them, can be somewhat divisive in their early stages. And you have believers and advocates, and you have detractors and people who aren't a fan of whatever people are doing one way or another. I had a Twitter account before BlockFi Zac that only tweeted a few things, but one of the things it tweeted was, if people aren't hating, it's because you aren't doing shit. So, and you can relate to this too. I mean, you have a What Bitcoin Did podcast, and people are throwing all kinds of shade at you at different times. But look, the way I think about it is this: the reality is, we started BlockFi in the third quarter of 2017. The original idea was to build debt and credit products for the crypto ecosystem, because that's our background. And we've expanded quite a bit since then. And today we think that not only do we have an opportunity to become one of the leading kind of crypto banks or crypto brokerages, but also that ultimately this crypto financial services ecosystem will start to compete head on with the traditional financial services ecosystem. And we hope to be a leader throughout both of those phases. And currently we're in our most popular product, which is the interest account. We're generating over $35 million a month in interest for our clients. And we've had perfect performance since the first month that we paid interest to our clients. And it's literally like people that own Bitcoin and are, bullish on Bitcoin as an asset, earning Bitcoin interest every month. And in general, the behavior that we see is that they just hold on to it. So we're like enabling folks that are advocates for the space to get their hands on more Bitcoin, which ultimately they hold on to. And we feel like we're still in the very early days of this. So we have a very exciting product pipeline, including products in the payment space that are going to make it easier, not only for the folks that we already work with who, in general, heard about Bitcoin before they heard about BlockFi, but we're going to increasingly look to create products and marketing messages that are relevant to folks that are crypto curious or maybe not interested in crypto yet, and help convert them into becoming Bitcoin owners. And so I think hopefully, assuming BlockFi doesn't fail completely, which the odds of that happening were already low, and they get lower and lower and lower every single day. They're very, very slim at this point. But hopefully people at a certain point, even if using BlockFi's products isn't for them for whatever reason, they don't trust us or they're worried about how lending works, they'll be able to look back and say, well, you can't argue that this wasn't a net positive for the ecosystem. And I think the same thing can be said about a lot of big companies in crypto. People might dislike Coinbase, or they might dislike Binance, or they might dislike, whatever other platform that's out there. But once you reach a certain level of success, a certain level of adoption, it's hard to argue with the fact that you've been helpful to the mission of enabling consumers and institutions around the world to become a part of this ecosystem, which ultimately enables the ecosystem to grow and the price to go up and the market cap to go up and adoption to go up. And at the end of the day, we're all on the same team for that effort.
Well, I get a lot of emails about BlockFi. So for transparency, if someone's listened for the first time and they've skipped the ads, which you shouldn't do, but if you have, BlockFi is a sponsor. It's my oldest sponsor. I've worked with Zac, known Zac for in our third year at least of knowing you. So I do have a bias. I have a bias as a customer because I like it. But at the same time, I said to Ben, who is new producer, what Bitcoin did. Say hello, Ben.
Hey.
Yeah, I asked him to join us because I wanted him to cover some of the things where I want to give you a kind of like put the real kind of questions that are out there into you. But there are, I mean, I'm getting a lot of emails at the moment. I would say at least a third of them are a reference to BlockFi, and it's it's a range of questions. What percentage of your portfolio would you leave with BlockFi? Do you trust BlockFi? Why BlockFi over Celsius, which is easy, by the way. And then it will be something like something will happen in the market and it's a reaction. So when that stupid website came out the other day, I must have 5 emails on the day asking me about that. So I'm always being asked questions. So it's worth getting you on. It's worth getting you to talk through some of these things. So I'm going to cover the basics. And then what I'm going to do is I'm going to hand over to Ben to get into some of the more kind of detailed stuff. But I know we've done this before, and I know you've done this 100 times, but I think we should just do the basics of what the BlockFi business is, so people understand how you work, how you operate. So, should we start on the lending side, or do you want to start on the interest side? Which is the easiest side to start?
I think
lending. Sorry,
I think lending and interest are connected.
Yeah.
I think maybe the easiest way to explain what BlockFi does is to talk about it sequentially from where we started, because where we started to where we are today, was really all driven by customer and market, demands. So the first product that BlockFi launched in early 2018 was the ability for folks to borrow dollars secured by their Bitcoin as collateral. And we launched that product right at the kind of top of the market, so around Bitcoin 20,000. And then the second product that we launched was the Bitcoin interest account, which is the ability for folks to earn a yield on Bitcoin and other crypto assets in an account with BlockFi. The reason that we launched that was as follows. So we had this US dollar loan secured by Bitcoin as collateral product in the market, and our phone started ringing, and it was institutional firms saying, hey, we'd be really interested in borrowing cryptocurrency. Right now, there's only one game in town where we can borrow cryptocurrency, and it was our friends at Genesis Capital. And they're price gouging everyone. And we think the market should have a few more participants, and we think that BlockFi is a good candidate for that. Would you be interested in doing this type of activity? And of course we were, because we always knew that we didn't want to be just a monoline lending business. The online lending world where Flory and I came from, that was one of the biggest lessons. Like, you want to be someone like SoFi that diversifies your product suite and adds more value for your clients through launching multiple products over time versus kind of a one-trick pony like a lending club. And once we decided that we were interested in starting to lend Bitcoin to institutions, it became very clear that the demand that these institutions had to borrow Bitcoin was a lot larger than the amount of Bitcoin we had access to with just that Bitcoin backed loan product. So those two ideas together combined for the launch of the BlockFi interest account, which came out in March of 2019. The idea is pretty simple. You can hold assets in an account with BlockFi and earn a yield on them at pretty attractive rates. So, the base rate for Bitcoin is 6%. For Ether, it's a little over 5%. And for stable coins, which are one-to-one interchangeable with dollars in a bank account, it's 8.6%. And these rates are high when compared to, the traditional financial market rates. And the reason for that is that this is still an emerging asset class. It's an asset class with a ton of growth built into it, a ton of volatility built into it, a ton of inefficiency still exists today in terms of liquidity venues and how connected or unconnected they are from each other. Credit isn't very widely available. So in general, you're able to offer much higher rates, which is really attractive to folks that are participating as lenders. And that product took off. And so I'm really excited that, Ben is working with you now. I've actually known Ben for a while. Ben was creating videos around the time that we launched the BlockFi interest account, like dissecting what this meant. And there was one of them, I forget the name of it, Ben, you might remember, but there were like 4 people on it. I think all pretty hardcore Bitcoiners. And it was like 2 hours of, what does this mean? Is it good? Is it bad? Is it going to fail? Do we like it? Do we hate it? Is it, Bitcoin banks, which is ultimately a good thing, or is it a scam, or is it something in between? Or, and it was a really exciting time for our business because love us or hate us, we got a ton of attention. And ultimately the way it's played out is that people, in fact, do love getting a yield on their Bitcoin. And so we've grown assets held in BlockFi interest accounts from 0 when we launched it in March of 2019 to over $15 billion worth of assets today, and generated hundreds of millions of dollars in interest that has gone to our clients. So fast forward about 6 months from that point, and the biggest complaint we were getting from our clients was, it's really cool that I can earn interest, but it sucks that I have to take my assets off of BlockFi if I want to trade them and then bring them back to earn interest again. So we took that feedback and we said, okay, you should be able to buy and sell assets directly on our platform. And we launched our trading product in December of 2019. So today, those are the 3 things you can do in our mobile app or our web app. You can buy and sell crypto. You can earn a yield on your crypto. Actually, by default, you're earning a yield on every asset that you hold on our platform today. And you can get a loan secured by the value of your cryptocurrency holdings. In the second quarter of this year, we're launching our 4th product on the retail-facing side of our platform, which is a Bitcoin rewards credit card. I don't know if we're doing video for this or it's just audio.
Yeah,
but
man.
I sit here spinning the card in my hands all day, every day, because
We're doing video.
I'm so freaking excited about it.
Dude, I want my card.
Me too. I think we'll have cards in folks that are either employees or influencers or good friends of BlockFi in their hands in like April, May, and then we'll start shipping them more broadly in the back half of May and early June. So we're really excited about that because it's great for our clients, but it's also going to be great for people who, for whatever reason, have been interested in getting some Bitcoin, but they haven't, crossed the chasm yet and actually created an account on Coinbase or BlockFi or wherever, or it's just a little too much to think of spending their own money to buy the Bitcoin. But if they could just earn it, that's a completely different proposition, and maybe that is something that they would be excited about. So we're really excited about that. So that's the retail facing side of BlockFi. We also have this part of BlockFi, which is the institutional facing side of BlockFi. Also, on the institutional side of BlockFi, we manage the risk, all of the financial risks. So risk management is a big undertaking. We believe fundamentally that we're in the business of risk management at BlockFi. But the institutional services side of our platform is responsible for our institutional client relationships, our market activities, our risk management, and they're responsible for the activities that generate the yield that we're paying to folks who are holding assets on the retail side of our platform. So we are today the largest lender through our institutional services product of cryptocurrencies to market making firms, proprietary trading firms, hedge funds, and also we're a very large financing provider to crypto native businesses like miners, ATMs, exchanges, etc. And then on the institutional side of BlockFi, we've really been a big lender historically, but now we're in the process of also adding trading functionality. So today, our institutional clients can trade over the counter, the spot market, and throughout the course of this year, our functionality there will be expanding to include derivatives, both futures and options. And from a tech perspective, our institutional clients will be able to trade on screen and via API with us as well. And last point, and then I'll pause because I know I've gone a little long here. Over the short to medium term, we believe that we still have a ton of wood to chop on just adding as much value as we can by creating new products and features for these two client segments that we have today. Crypto market participants on the retail and institutional side of the equation. But medium to long term, we think that crypto financial services is going to compete head on and ultimately, disrupt traditional fintech and traditional banking, because there are things that you can do better, faster, cheaper from a starting position like what BlockFi's had than from a traditional fintech or a traditional banking starting point. So we see a world where folks like Coinbase or Binance or BlockFi or others are competing with JP Morgan Chase or PayPal. You could honestly say that's already starting to happen in the case of PayPal and other fintech companies. So that's what we're working towards long term. We think there's going to be a world where financial services are a lot more available globally and at much less fragmented kind of rates and constructs. And we think that evolution is going to be powered by Bitcoin and what's happening in the broader crypto ecosystem.
So it's just a little crypto business you've built up there, then.
Yeah, I mean that soapbox I just stood on for a minute. That was basically the opening pitch to investors for our Series D round of funding, which we just closed.
Yeah.
And
congratulations on that.
Yeah, thanks. And Peter, you were the first person going back a while now. You said that you're going to build a unicorn, and I remember the first time you said that. I think it was after our Series A, and I didn't really believe you. I was like, "Holy shit, no way!" I mean, maybe, but I don't know. So look, we're really excited. We raised $350 million from a great group of investors. You can check out the press release, but world-class investors, and it was at a $3 billion valuation, and we're going to use the money to keep growing our team, keep building new products for our clients, and
keep sponsoring podcasts.
Keep sponsoring podcasts, and I think we'll also potentially get active in the M&A market, make some acquisitions over the next 3 to 18 months.
That's interesting.
We'll probably keep making acquisitions forever, but I think we'll start being active in that market for the first time this year.
That's a big deal. Okay, well, listen, we'll get into that later. Okay, so let's get in. Let's dissect some of these parts of this business. The bits that people always ask about, and I know you covered this with Preston Pish. I listened to that; it was a great interview. So these institutional borrowers, let's just get into it. I know you've told this 100 times; it must bore you to do it. But like, who are they? What are they borrowing it for? Why are they borrowing it from you? Like, why don't they just hold it themselves? How are they generating essentially their own yield so they can pay back you guys with interest? How does that all work?
Sure. So most of them are doing market making, proprietary trading, kind of arbitrage type activities. There's a pinch of shorting and a pinch of crypto native businesses borrowing for inventory. So I'll give you an example of each one of these things.
Yeah.
So let's say, Peter or Ben, you work at Susquehanna. Susquehanna is one of the most successful market making firms in the world. What does a market maker do? They buy things for 99.9 cents and sell them for $1 and a penny in all sorts of asset classes. Market makers get paid for providing liquidity into certain markets, and they get paid by the delta between those two prices that they're making a market at. And so, if you're someone at Susquehanna who's convinced your boss that y'all should take your market making capabilities and bring them to the crypto ecosystem, and your boss says, okay, go do it, Peter, here's $10 million. And you take the $10 million and you go load it up on a few exchanges, and you start market making. Things go really well because it turns out that crypto is very volatile, liquidity is very fragmented, and so it's a very ripe market in terms of opportunities for market making firms. So a month or two goes by, you're using the $10 million, and you come back and you say, it's worked phenomenally. We've made a lot of money. The returns are great. The risk is low. I'd like to increase our activity by a factor of 5 or 10 or 20x. We should be doing this with $100 million or $200 million. But then what your boss says is, okay, great. I don't want to put up the $100 million all from Susquehanna's equity capital. Go find a prime broker who will finance our market activities. And that's the point at which they end up calling someone like BlockFi or Genesis, because their traditional prime brokers are not active in this asset class. And so they call us, we underwrite them, understand what they're doing, and then offer them financing. And a lot of that financing is denominated in Bitcoin. Why is it denominated in Bitcoin? Because Bitcoin is the inventory that you need to trade this asset class. And so these market making firms need to have some Bitcoin on hand. The same way that someone who's market making, for an ETF holds some of the underlying shares that represent the makeup of that ETF, because it's helpful for them to stay neutral in their market making activities. So that's number one, proprietary trading.
Can I jump in there? Let me just ask you a couple of questions there. So essentially, through all of this, Bitcoin is the unit of account. It's the unit of account for what I deposit with you. It's the unit of account of interest I get paid. It's the unit of account what they borrow, and is it the unit of account of interest they pay to you?
Yes.
And essentially, it's the unit, and it's the unit of account they use for market making. So, what am I guessing? At the end of a period when they have to repay their loan to you guys, they will pay back the Bitcoin they've borrowed plus the interest, and they themselves will have accrued some Bitcoin themselves, and that will have a dollar value at that time.
That's correct. So all the way through, it's denominated in Bitcoin. So you hold 1 Bitcoin in your BlockFi interest account. BlockFi takes your 1 Bitcoin plus 99 other folks' 1 Bitcoin, lends 100 Bitcoin to Susquehanna. We're paying you 6%. So at the end of a year, you're all going to have 1.06 Bitcoin, regardless of what happens to the price of Bitcoin. we lend 100 Bitcoin to Susquehanna, and at the end of the year, they're going to pay us back 107 Bitcoin. And that's kind of like a representative example. And so then in that scenario, BlockFi makes 1 Bitcoin. Our clients all made 0.06 Bitcoin because they're all just holding, 1 on our platform. But it's denominated in Bitcoin all the way through.
And that 7 Bitcoin comes from essentially liquidated traders.
It's liquidated traders. It's it's helping tighten the market. So you see things all the time where the price of Bitcoin on different exchanges or in different markets diverges.
Yeah.
And in that it's that exact scenario where market making firms are just printing money. Because they say, okay, we've got a ton of money. We have money in all these places. Our system sees that Bitcoin is going for 57,000 at Kraken and 56,800 at Coinbase, and they buy it at one and sell it at the other.
Right. Okay. So it's just efficiency. Okay. And with these clients, are they having to collateralize the loans with you? Are they having to provide guarantees? What's the due diligence? What's your risk exposure to them? A market collapse and a business going under. Because, okay, I'm sure you only work with the best, but there was a time where nobody thought Lehman Brothers would go under. So what is this is the reason it's not a zero risk, right?
Yes. So I encourage folks to watch any of the podcasts or videos with Renee Van Kesteren. He's our chief risk officer, and he generally only talks about this type of stuff when he's on shows. But the simple answer is for firms like Susquehanna, where they have billions of dollars in equity capital, they've operated profitably for a long period of time. Less than 5% of their business is in the crypto market. BlockFi can generally get comfortable taking some credit exposure to them. And what does credit exposure mean in this context? It means with their 10 million that they're using to trade crypto, we would give them financing so that they could trade 50 or 100. So, we've lent them 40 or we've lent them 90. Ultimately, with 10 of their own equity that they've put up to do these market making activities. But importantly, one of the many things we look at during the underwriting is, where is this entity in the corporate structure of Susquehanna? If this entity were to blow up, does it pass through to the parent where all of the money sits? And we make sure that all of those things are true before we give anyone credit. And to date, there's been less than 50 out of 250 institutional firms that have qualified for that type of credit exposure lending. And generally, they all meet a similar profile as Susquehanna. Then let's say there's, Peter and Ben's market making firm, and y'all made a ton of money from the What Bitcoin Did podcast. And so you're taking $5 million and y'all are going to go start making markets in crypto. The maximum you would be able to borrow from BlockFi, because you don't have billions of dollars in equity and all of your business is in crypto, and you don't have a long track record of making money by doing these activities in a incredibly low risk way, is maybe $5 million of equity, 3.5 or 4 million secured by your 5. And so in that case, if you start to get off sides in terms of your positions, we could, BlockFi has sufficient capital from you to close out your positions before we've ever been, put at risk of losing a penny. And there's a separate, but similar kind of way that risk management works for our retail loan book. But, we've done these things since January of 2018 through multiple periods of volatility, including, the most significant down day of volatility that we've ever had back in March 11th. There's some interesting kind of learnings from that market event that I'd be happy to share. But also now, from March 12th to today, we're up 11x ish.
No, dude.
And look, we've had perfect performance the whole way through, and perfect performance not only in the sense of course, our clients' capital and BlockFi's capital has been protected, and we've delivered the interest rates that our product delivers, but also in some more qualitative areas. And one of the biggest things you learn being in this business is that sometimes, like, the math part of the risk management can be relatively easy, but there's a people component to it, in terms of BlockFi's operations and training of employees, but also in terms of how we interact with our clients and our desire to have a very long-term relationship with our clients, that are important as well. And those things don't exist. That second stuff, the long-term client relationship, they don't exist in other areas of this ecosystem, in particular DeFi, where I love DeFi. I'm a personal fan of it, but it's just very different. There's no one to call and say, hey, the blockchain was a little congested when I tried to send you more margin. So can we work something out here because you liquidated my loan? I mean, it's just, no. The answer is no on DeFi.
Yeah.
It's a little bit different at BlockFi.
Okay, so that's part of the institutional customers, but you said there were others.
Yeah, so I'll give you examples from each bucket. So that was market making. Then there's proprietary trading. There's kind of long short, which would be shorting, and then there's crypto native. So proprietary trading. And we'll probably talk about this somewhere else in the show, so let's use it as an example. The Grayscale Bitcoin Trust. Up until about 2 weeks ago, the Grayscale Bitcoin Trust traded at a premium to NAV, meaning, there were 100 Bitcoins sitting in the box, and the fair market value of those today is $5.6 million, but actually the shares were trading at an implied valuation of $7 million. And what arbitrage and proprietary trading firms would do in that scenario is borrow Bitcoin, subscribe to create new shares of the trust. When those shares became liquid and freely tradable, sell them and pay back the Bitcoin. So they borrow 56, $100 worth of Bitcoin. Ultimately, they sell it. They make 7,000. They pay back 5,600, and they keep the difference. That's how the trade worked when it was at a premium. Now it's at a discount. So the way the trade works now for folks that are doing it is they borrow Bitcoin, sell it, take the cash from selling that Bitcoin, buy shares of GBTC, which are trading right now. They closed yesterday at just under a 5% discount. I think it was like 4.75 or maybe 4.5% discount. Buy shares of GBTC. When that discount comes back to closer to the NAV, they sell it, pay back the loan, and make the difference.
Why does it trade at a premium and at a discount? What are the reasons?
It's really a function of supply and demand, intersecting with the fact that this is a trust product, which does not have the same creation and redemption mechanisms that an ETF does. So going in reverse order, an ETF, you can constantly and effectively in daily or sometimes real-time cycles be buying more assets for the ETF or selling assets out of the ETF to keep the price of the ETF in line with its underlying holdings and the activity in the market. With these trust products, which is what we have in the US, because the SEC hasn't been willing to approve an ETF for Bitcoin yet, that subscription and redemption mechanism works very differently. Basically, to create new shares of these trusts, you have to subscribe and then wait for somewhere between 6 and 12 months, depending on the product. And there is currently, for the Grayscale trusts at least, no redemption mechanism. So things can go in, but they can't come out. And so historically, these things traded at a premium. Why? Because GBTC was really the only thing you could buy in your retirement account at Fidelity or Schwab or somewhere else and get Bitcoin exposure in a traditional kind of brokerage construct where you already have your IRA money or your 401k money or whatever it is. And the reason I think they're starting to trade at a discount now is a function of a few things. There are more products available in the marketplace today, both in terms of other trusts and in terms of ETFs in Canada getting approved and ETNs in Europe. There was maybe a week and a half ago now, because long-term Fed rates are rising. You've seen the beginnings of, or at least a short period of a rotation out of tech and into more cyclical, value-oriented stuff. And I think Bitcoin gets caught up in that a little bit in the traditional equities market, at least. And you have some actively managed ETFs, most notably the ARK ETFs and specifically ARK-W, which hold GBTC and which are ETFs, meaning when ARK-W experiences outflows, they're a forced seller of GBTC because that's one of the underlying holdings of ARK-W. And so we think all of these, all of those factors together came about, and now GBTC is trading at a discount. And we can talk about how long that might last and what things you're going to see happen in the interim. Digital Currency Group already announced that they're buying, getting set up to buy it up to $250 million of GBTC. And they'll do other things because it's really bad for Grayscale to have GBTC trading at a discount, because you'd have to be a complete moron to subscribe to create new shares of GBTC while the liquid shares are trading at a discount. So Grayscale has a tremendous incentive to get the liquid shares back to NAV or a premium, because otherwise their spigot of new subscriptions is completely shut down. Because you would never, Peter, say, oh yeah, I'm going to subscribe to create new shares of this trust and wait 6 months before the shares are freely tradable. And I'm going to pay, net asset value for that, when you could buy the same shares for a 5% discount on the open market today, and they would be completely liquid. So, we'll see how these things play out. I think ultimately, the question in my mind isn't whether we get closer to NAV. I think that's a given. The questions are how long it takes for that to happen, why that happens, which could potentially be because the Grayscale Bitcoin Trust gets converted into an ETF. So it's a question of the duration, the why, and whether it goes back to trading at a premium again in the interim, which I think there's a reasonable chance of that happening. So that's your arbitrage one. And the biggest things that these arbitrage funds have done are either Grayscale and other products like it, arbitraging the inefficiencies and capturing that premium, or now capturing that discount. And then they've traded the futures basis. So the futures basis is when the future price on CME futures or offshore futures is higher or lower than the spot price. It's either in contango or backwardation. Generally, when the market is bullish, it's in contango. When the market is bearish, it's in backwardation. And what you can do with that is, when we're in contango, so the March Bitcoin future is trading at 58,000, but the spot market is trading at 57,000. You can sell the future, buy spot, wait till futures expiry, which is the point in time at which those two prices will converge, and you make the delta. So you make $1,000 over that period of time, and then you can annualize that to get an implied yield. And the implied yields on futures basis have been insanely high recently. Like, you've been able to make 15, 20, 25, 30%, taking, basically CME and crypto spot exchange risk, which is pretty de minimis in my view. So those are the two biggest things that arbitrageurs do. You're starting to see some activity in the options market, which is becoming increasingly liquid. So there's other strategies that you can do in options where, similarly to the other two, you're generally market neutral, but you're making some implied yield. And for all of those things too, there's a need to borrow. And why do you want to borrow? Well, let's say that implied yield on the futures basis was 15%. Let's go back to the example with Susquehanna where you've got $10 million. Okay, I've got $10 million. I'm going to do the futures basis. I'm going to make 15%. I'm going to make 1.5 million. Well, what if you did it with 20 million? Okay, well then you're going to make 3 million instead of 1.5. What if out of that 20 million, only 10 million of it was your money and the other 10 million was money that you're borrowing at a 7% rate of return, or at a 7% interest rate? Okay, well now you're making 15 on your equity plus another 15 minus 7, which is the return on the 10 less your cost of borrowing. So you've just increased your net return, and you haven't taken on incremental risk because the structure of the trade is market neutral. So that's arbitrage. And then the third thing is shorting. This is probably the tiniest, especially recently. But
people think a long time people have thought it's like the main use, right?
No, I mean this is tiny. Like it's probably never been more than 5% of our activity. So the example for shorting is, let's say you're a long short hedge fund. So your job is to look at some universe of assets and say, I think this one's going to go up over whatever period of time. I think this one's going to go down, and I'm going to be long this one and short this one. Whatever assets you want to go short, you need the ability to borrow and then sell, because that's how you put on a short position. And BlockFi does facilitate that. I mean, today it's probably close to zero in terms of what part of our lending book is shorting. But look, if we have another cycle where, let's say, we're shooting up to somewhere between 100 and 400,000 over the next 12 months, and then we pull back down to 75 or 100,000 from 200, like some of that shorting activity, will pick up in there, but it'll still be small relative to the overall book. And then the last one is crypto native businesses. So let's imagine you're a Bitcoin ATM operator, and you're basically in the business of selling Bitcoin to people. And because of some of the nuance in terms of when you show a price on the screen and deliver the Bitcoin to the client, it can be really valuable to have some inventory available that you don't necessarily just have long exposure to on your balance sheet. So you could borrow some Bitcoin, make some income in Bitcoin by then selling the Bitcoin. Or let's say you're an exchange running a fully funded margin trading platform, and the margin trading demand keeps increasing. You can't finance all of that activity with your equity capital. You could raise more equity, or you could use debt. The same way when you're running any business, you think about equity and debt as options for financing. We're a provider of financing there. So across these things, the activity is directionally like 80% market making and proprietary trading firms, 10 to 15%, maybe 10 to 20% crypto native businesses, and then 5% or less shorting. And
would you say that just the majority of it is using Bitcoin as the unit of account all the way through?
Well, Bitcoin is, by far the biggest part of, BlockFi's asset makeup. So out of the, a little north of 15 billion now of total assets on our platform, around 60% of it is Bitcoin, and the rest, about 60% is Bitcoin, 20 to 25% is dollars in the form of stable coins, and the remainder is the other cryptos on our platform, which are Ether, Litecoin, and Link. And then there's a tiny little pinch of PAX-G, which is gold.
Just a casual 15 billion.
Yeah.
That could be
casual when we're on a podcast like this, but we don't treat it casually in any regard.
No,
I mean, there's been
man.
some incredible developments in terms of BlockFi's systems and team since the last time I was here. I mean, we're over 500 people now. We're over 500 people. We've got a very, very robust, not only financial risk management operation, but also cybersecurity risk management, operational risk management, legal and compliance.
Yeah.
Operations.
But that's insane, Zach. Because I remember that for first place I came to, it was 15 people, 20 people.
Yeah, I mean, the first time we met, you were at our office in Tribeca. It was like a 15-person office with 2 conference rooms, and conference rooms is a strong word, more like closets with a couple desks in them.
Yeah, and then I got the Uber copter to your next one, and that was maybe 50, 60 people.
Yeah, and we were sharing that one.
Yeah.
It was maybe 60 for BlockFi, and there was another company in there with 15 desks. That's still the one we have, but we're in the process of starting to look now for a new office that we'll go to once we're allowed to go to the office again, when everybody's properly juiced up on the vaccines.
That's pretty insane. 500 people. Okay, so I think that's a kind of clear understanding of that side of the business. Ben, is there anything you want to ask about that side?
Yeah. So, I mean, I definitely have a bunch of questions. So, I think the thing that you touched on, Peter, that I wanted to just get a little bit of clarification from Zach was are the loans that you're giving out collateralized? You mentioned that you're talking about the equity of these firms and how, a larger entity with a larger reputation, it gets a little bit more leeway than maybe a smaller entity like Peter and I's bucket shop example that you gave there. But I was curious, are you actually physically collateralized? Are you taking some fiat to give out Bitcoin, or are you just looking at their equity overall?
The answer is it's a spectrum. So we're doing both. On one end of the spectrum, we're taking liquid collateral, which could be dollars or euros or crypto assets, and holding that to cover something that someone has borrowed and margin calling and liquidating it the same way we would a retail loan, where folks are exclusively borrowing dollars secured by their crypto. Then there's scenarios where we take something that might be illiquid as collateral. So, for example, shares of the Grayscale products or other products while they're still in the seasoning window. And then there's scenarios where it's really effectively corporate credit type risk. Where we're not receiving any explicit collateral for a particular loan, but it is guaranteed by the company. So we're doing all of those things. The majority of the book is collateralized with something, excluding the corporate loan part. Probably 70 to 80% of it isn't that. This is basically a corporate loan where they're not sending us any assets whatsoever as collateral. And the remainder is either secured by fully liquid assets like fiat currency and other cryptocurrencies, or assets like shares in a trust that might be illiquid for a period of time, but will ultimately become liquid.
All right. That makes a lot of sense. So I definitely wanted to dig into a few things. One, I wanted to actually say that, you mentioned there was that video that we did a long time ago. It was called the Mystery of BlockFi with my buddies Max and Zane and Tib. And it's funny because when you guys first kind of came on the scene, I don't want to go on a huge monologue here, but we were just finishing Murray Rothbard's The Mystery of Central Banking. And here comes this Bitcoin bank kind of emerging onto the scene. So I found it fascinating, and we kind of dug in there, and we were ready to kind of tear you apart and say, these guys are, it's systemic risk and all this stuff. And we learned a lot in that. And one of the most interesting things I learned about what you're doing is avoiding maturity transformation, which is a really fancy word, right? That basically means that in the traditional banking world, even if the loans that banks are making are good, that if everybody shows up at the bank at the same time and tries to withdraw their money, even if all the loans are solvent, the bank becomes insolvent, and you get a bank holiday where they just say, we don't have the money. And what BlockFi is doing is avoiding that situation by saying that there's a withdrawal window on both sides, meaning, if I'm depositing my Bitcoin in BlockFi and I need to take it out, you might give me up to, I think it was 7 days, at least when you first launched. And then the same is true on the side that you're lending, where the people that you're lending to, the institutions, you can call that loan back essentially within a 7-day window. I found that really interesting because I think that's the biggest part of this evil word, fractional reserve banking, that Bitcoiners just absolutely detest and are kind of scared of, when they really should be mad at the Fed, the lender of last resort, who distorts the risk. I was wondering if you just wanted to briefly just talk through how is this preventing that systemic risk that we're kind of touching on here?
Yeah, I mean, look, I think there's a few things that are fundamentally different about the way BlockFi operates versus the traditional banking sector, starting with the fact that there is no ability of anyone to just print a bunch more Bitcoin if things go, haywire for some type of Bitcoin bank. That's not a thing, right? So there is no backstop in the same way that there is for the traditional system. And then in terms of how that is implemented practically on BlockFi, there's a couple big differences. I would say number one is the maturity transformation aspect. So in general, you could think of a bank as taking overnight deposits and making a lot of 30-year, mortgage loans, for example. And so you've got this tremendous amount of maturity transformation. And at BlockFi, we don't, we're not doing that. It's technically in the interest account, we have up to 7 days to process withdrawals when someone withdraws. We've never actually used that. We process withdrawals in 1 business day, but technically we do. And then when we're making those loans to institutions on the other side, we can close them out on shorter duration than that 7-day window. The other thing I would say just goes to reserve ratios. So I think right now, I don't think they've changed it, but I don't think banks are required to have any reserves, at least the biggest ones, because of the liquidity risk in the system coming out of COVID. And so they have a 0% reserve ratio. Now, we don't necessarily have a regulator at BlockFi telling us, here's your required reserve ratio, but we're very aware of that. And we're very aware of the unique properties of Bitcoin and how that, what implications that has for our business. So we don't ever lend out more than 20% of the assets on our platform. So we've got 20% just sitting around at all times, and then we're not doing maturity transformation. And then the last thing I would call out is that structurally, our equity capital sits ahead of our clients' capital in a loss scenario. So we're always looking to raise, more equity capital and strengthen our balance sheet, because that's another one of the protections that's kind of embedded in how we've designed the BlockFi system.
Is that to allow you to? Is that almost like an insurance against any kind of partial failure part of the business?
Yeah, I mean, look, it's just it's a capital buffer, right? So one part of it would protect against a loss scenario where the bigger equity capital base you have, and we actually book loan loss reserves now. We started doing this at the end of last year for accounting purposes, not even because we think we're going to encounter losses necessarily. We've actually never, encountered a loss to date, but because we felt like it was prudent. The other thing that we do is we set up lines of credit, which could be either secured by BlockFi as a company or secured by collateral, which would enable us to draw on liquidity, to bring more liquidity into our system if we ever needed to. So, we're always thinking about fortification of the balance sheet and risk management in the context of the type of risk management that we need to do, which is unique given that we're operating primarily with Bitcoin.
And I wonder on that point that we were kind of talking about the maturity transformation. Peter mentioned a website that was relatively scathing that came out and was talking about y'all maybe taking advantage of those GBTC premium swings. And what I was really interested is the idea that is it if you're taking advantage of these GBTC things, if there's any truth essentially to what the website was saying at all, because it sounded like to me they were inferring a lot of their numbers, and they claim to have a bunch of information about what you're doing with your capital, which I found surprising. But what I'm really interested in is that is if you're locking money up in the GBTC premium trade, is that possibly taking apart that maturity transformation avoidance? Does that make sense? I'm not saying it articulately.
Yeah, absolutely. No, I understand the question. So said another way, the question would be like, if Bitcoin is going in to create new shares of the Grayscale Bitcoin Trust, is the maturity on that necessarily 6 months or whatever the seasoning window before the shares become liquid is? And actually, BlockFi's view is that while shares of GBTC don't trade freely on the open securities market until after that seasoning window, there's a very liquid market for them even before they're freely tradable in the traditional securities market. We know that because we're very active in that market and we know all of the other folks who are active in that market as well. So if to give you an example, if you've been, subscribed to create shares of the Grayscale Bitcoin Trust, you would have to wait 6 months before they show up in your brokerage account. But if something happens 2 months after you subscribe to create those shares and you just wanted to get out, there's a lot of people you could call who would buy them from you. You might not get the same price that you would get if you waited 6 months, but there's a price, and it's a very liquid market. I mean, ultimately, this thing is a derivative of Bitcoin, and Bitcoin is incredibly liquid. So, and then just on the point of that website, since you brought it up, there have been all kinds of forms of mudslinging at BlockFi throughout our existence, and most of the time you can tell whether someone is looking to have a thoughtful dialogue about risk management or providing feedback or constructive criticism, or if it's just trying to kind of slander you. And I think the website that you're referencing was definitely the latter. And so it comes from a place of, I saw rumors that it was a specific competitive firm, or who knows. But like, our position at BlockFi is if we keep being successful, there's inevitably going to be people who are, trying to take us down or spread FUD or whatever we want to call it. We're going to stay focused on what we think we do best, which is adding value for our clients, helping to promote the ecosystem and deliver more value to our clients by launching new products. And you really can't engage with it. Like people are always like, well, why don't you issue a formal response? It's like, well, if you issue a formal response to something like that, then literally the people lobbying these, deflammatory like accusations at you, then they win, because then they're getting attention on all this stuff, and maybe people find out who they are. And so you can't go. There's an expression someone told me. It's like if you get in the mud with a pig, you'll get dirty and they'll have a great time. So I think our approach is like, look, we're not going to go play in the mud with pigs. We're happy to have thoughtful conversations about our risk management or what we're doing anytime, but we're not going to get into the mudslinging. We don't think it's good for the industry in general. We want to be promoters of the industry, and so we're not going to stoop to that level.
All right, I definitely want to make sure
I know that I just drew it up. Is that never wrestle with a pig? You both get dirty, and pigs like getting dirty.
yeah, there it is. Yeah, so never wrestle with a pig. You'll get dirty, and the pig will have fun.
Zac, I wanted to ask you about on gaps, right? I know one of the things that I identified early on is there's this idea of gap risk, and I know you guys do all sorts of really interesting things to try to avoid that, and have things that are watching the markets all the time. There was that market bloodbath in March last year, obviously. It sounds like you guys did really well. I'm curious. One, was it a really scary time? And two, because that was a big gap down, and we have seen gaps up in price recently. Possibly, this is just the beginning of a huge bull run. We could see, $1 million prices. Maybe some of the higher calls have said. If that happened extremely quickly, I wonder is that a harder situation to deal with than a gap down? Is it just depends on which side of the part, which section of the business you're looking at? I think these big moves are one of the things that I've identified as the largest risk, and I could be wrong there, especially because you've kind of illuminated that shorting is not as large a part of the business, I think, as a lot of people think it is. So I'm just curious how you think.
Yeah, just to add to Bed's thing there as well, Zac. It's so I was chatting to somebody and they said most of the people who have concerns over BlockFi just don't understand the business. But if we started to see big moves up, if you started to see like 30,000 moves up in a day, that would be something that he would have concerns over. Obviously, you're going to risk plan this. So
look, if in general, let's take two periods of time. Let's take 2018 and let's take the last 12 months. So 2018, generally speaking, volatile, but in a downwards spiral, ultimately ending in kind of like a capitulation puke from 6K down to 3K, and it wasn't 50% in a single day, but it was close back in like October of 2018, I think it was. And then the last 12 months, where let's exclude March 11th, we're past that now. So starting on March 12th or 13th through to today, where we're up 11x. BlockFi is thrilled, and our business does phenomenally well in periods like the last 12 months. We do well, and we're, it's not that we're at risk of losing money in the periods like 2018, but it's not nearly as fun. At the end of the day, we're a crypto financial services company, and we want the size of the Bitcoin market to grow. And in terms of like gaps, I mean, is it a risk? Yes, absolutely. Do I think it's realistic at this point with Bitcoin to expect a 50% gap up or down with no liquidity in between? I don't. And the reason I don't think that's realistic is because if you analyze the structure of the market in terms of where their liquidity is, in terms of the derivatives that you have in addition to the spot market now, and if you just track volatility over time relative to liquidity, um, and also if you think about the constituents in the marketplace, where increasingly now we've had institutions come in, and the reality is they'll take profits more frequently than maybe a highly convicted retail Bitcoin owner who sees this purely as a long-term bet and isn't necessarily thinking of it in the context of needing to deliver a realized return every year to their LPs. So fundamentally, we're Bitcoin bulls. What we're trying to help support alongside yourselves and everyone else in this industry is growth of the Bitcoin market cap. We would much rather see that happen than see things the other direction. We monitor gap risk. There's a lot of things that we have in place in terms of access to liquidity, the ability to hedge these things, the construct of the portfolio that mitigate the risk. If Bitcoin gapped up 50% tomorrow with no liquidity in between, BlockFi would be fine. We would be better than fine. We would be like popping champagne alongside everyone else that owns. It would be phenomenal for our business. But it is something that we very actively track and monitor. And one of the most important things is that you've got access to a bunch of different venues where liquidity is available, and you have sophisticated risk managers who, when markets get volatile, they can hedge things. Going back to March 11th, which is our last kind of, and I don't even know that too much of that was a gap. I mean, you had gaps on March 11th, but it would be like a 5 or 10% gap. It wasn't like a 50% gap down. We were the only institutional lender that was open for business, and retail lender. We were also open for new retail loans, but we were the only institutional lender that was open for business on March 12th. And I think we were unique in terms of how we handled things on the retail side of our loan book, in that we did, work with clients for a period of time after March 11th in exactly the scenario that I described earlier, where you have someone who's saying, maybe, I sent you more collateral. You can see that I sent you more collateral because it was pending on the blockchain, but I wasn't using a wallet, or I'm not, a sophisticated enough Bitcoin user to have input a high enough, transaction fee to have had that transaction process fast enough relative to the price moving. Because that was a big part of what happened on March 11th. Like, it was hard to move money around because the fees increased dramatically, because everyone was trying to move money around and get it to different points to capture arbitrage opportunities or buy more or sell some or whatever. And we worked with our clients on that stuff.
Right, because people have to like recapitalize those loans. Listen, I have two main questions left. If you still have time, Zac. The first one's about this co-mingling idea, the idea that the Bitcoin-backed loans make a lot of sense to me. I take my Bitcoin, I give it to you, I get fiat out of it. You just hold the Bitcoin. The way you're making money is I'm paying you more fiat back, right? And, obviously that same LTV stuff applies, but it makes a lot of sense to me. The lending side of it, I'm very risk averse, obviously. I've learned a lot about your company. I think it is really cool what you guys are doing, but I personally would kind of, I'm less likely to use that product because it seems like there's a little bit more risk in it because you're the lending and all that stuff. I'm wondering, there's a potential for co-mingling between these two products. And I'm wondering, what that would, what can an investor think about when they're thinking about that risk?
Yeah, look, this is a really easy one to answer. Today, they're absolutely commingled. We are likely later this year going to introduce an account where you don't earn a yield on Bitcoin, but it is just held safely on the BlockFi platform, where you can trade it and get a loan. Once that comes out, it won't be commingled in the way that you're thinking, Ben. But today it absolutely is, and so folks have to keep that in mind and be comfortable with it when considering our loan product on the BlockFi platform versus maybe some of the other products in the marketplace. My guess is that you're going to pay for it with some of the other. If you want a non-commingled option, the rate that you're paying to borrow the dollars is probably a little bit higher. I could be wrong. I haven't looked, but if the market was relatively efficient, that would be the case. But they're definitely commingled today at BlockFi.
Okay, appreciate that. My last main question. Listen, we got to ask Zac. This isn't the What Shitcoin Did podcast, right? You guys adding all these other altcoins and stuff. I'm guessing based on what you've talked about so far is it's based on market demand, but
Ben, do you know how far back me and Zac go? You can't throw this one in without telling me. I have no idea. I didn't know this was coming. Fair enough. Go on. Do it, man.
Is it additional risk adding altcoins and DeFi and packs and Link? Man, Link is the big one that surprised me. Zac, what's the deal, brother?
It's capitalism, man. I mean, ultimately, it's capitalism and client demand. I mean, look, I've said publicly multiple times that, I'm like, depending on the day, 90 to 95% Bitcoin, but I hold a little bit of ETH. And that's about it. That is it for me personally, in crypto. But these things are small, between Bitcoin and dollars, it's 80 to 85% of our platform. But clients do use them and they trade them. And we definitely don't have the plethora of shit coins, to use your terminology, Ben, that other places do. And part of the reason for that is specifically our risk tolerance, and in particular liquidity is incredibly important. And a lot, you don't have to go too far down the market cap list to find things that are incredibly illiquid relative to their market cap, and that's an area where we don't intend to go.
And in fairness to Zac, from day one I said in the sponsorship and the ads, we're never going to talk about altcoins, shitcoins, whatever, and Zac's been cool with that. We've only ever promoted Bitcoin, which is part of what we originally agreed. I've got a few other questions, Zac. Just considering the wider market, there are some competitors out there. And it seems to be growing, other companies moving into this. Firstly, is there almost unlimited demand right now to borrow Bitcoin? Does there ever come a time it tops out and you have to say, look, we can't take any more on because we've hit the demand cap?
There's definitely not unlimited demand to borrow Bitcoin, but there's two important variables there. So one is that the demand to borrow Bitcoin that BlockFi wants to capture comes with an asterisk of at what level of risk. And we don't have a very high risk tolerance. Yes, if you're looking at just, not lending Bitcoin at all, that's a lot less risky than lending it. But then once you go into lending it, our risk tolerance is very low. So there's a lot of Bitcoin lending opportunities that we wouldn't touch with a 10-foot stick because they're simply too risky. We like stuff where it's really hard for us to make a case that we could ever lose a penny. That's the type of lending that we like to do at BlockFi. So that's one side. The other side is you can adjust rates. So, depending on how much Bitcoin lending you're able to do relative to how much Bitcoin you have, you can reduce rates that you're paying to depositors, if you aren't keeping up on the borrowing demand side of things with the supply that you have of Bitcoin to lend, or you can increase rates, which is actually the last time we changed rates on Bitcoin, we increased them, and it was in April of last year. You can increase rates if you want more Bitcoin to lend. And so I think the growth that you're seeing is a reflection of market demand and the success of companies like BlockFi, and so a lot of people are saying we have to, get into this too. But it'll be interesting to see what happens to Bitcoin lending markets. I think if I had to guess today, I would say dollar rates go up, Bitcoin rates go down in terms of what you're paid as a lender over the next 3 to 9 months. That would be my informed view. But we might see something different.
Okay. Another thing, a question, because I'm obviously based out of the UK, 15% UK audience. I've got quite a few people asking when can they borrow against their Bitcoin. There was a point you could borrow, I think it was a large amounts you were doing, and now you're not doing any UK loans. I know the UK is a particular pain point for Bitcoin companies. Do you know what's going on there?
Yeah, I absolutely know what's going on. So we used to make loans to folks in the UK that were above a certain size. I think it was £55,000. And that's kind of a level in which the government says, okay, these are, basically rich people, so it's fine. Now BlockFi is in the process of getting set up as a regulated, licensed company in the UK, in addition to licenses that we already hold in the US. So our legal team made a decision that while we're in the process of getting that official license set up, we should probably just, not make any more loans than what we've already made. But we're coming. I want to be up and running in the UK like we are in the US, which goes all the way to folks being able to easily send us money to and from their bank account.
Okay, awesome. And another thing that's on my mind at the moment, having had my bank accounts closed down by Lloyd's Bank recently, it feels to me like a company like BlockFi is half of the way there to what somebody like I need. Okay, I can hold Bitcoin in an account and get interest. I can hold dollars and get interest. Ideally, I could hold pounds and get interest. You're going to have a credit card coming soon, which I can use. If you had something like direct debits, like TransferWise have, that almost closes the loop of all the things I would need from a bank account. Is that a direction you're heading in? Is that a possibility? Do you see, I always talk about you as a future of banking, but do you see that as a possibility that companies like BlockFi end up providing the services that banks aren't willing to provide?
Yeah, I mean, look, you basically just laid out a big part of our roadmap. So
right, okay.
That's exactly where we see it going. I mean, look, I think that, 2 years from now, someone in the UK or in a lot of other countries in the world should be able to do all of the following things on BlockFi: earn a yield on Bitcoin and traditional currencies, or just safely hold it and not earn a yield. Send money to and from that account using every traditional payment rail that they're familiar with, direct deposit or SEPA or whatever payment mechanism, and take it off using those same payment mechanisms and all of the cryptocurrency payment rails, which are already kind of integrated. They should be able to spend using a credit or a debit card, ideally one that gives them crypto rewards, Bitcoin rewards for that spending instead of traditional points. And I would add one thing to the roadmap, which is you should also be able to make peer-to-peer payments in any currency that you choose. So if you're, splitting a dinner bill with Ben, you could just instantly, using each of your BlockFi accounts, send him pounds, Bitcoin, euros, dollars, whatever, and it would be done. So, and that's what I was kind of alluding to earlier. It's like, I think these things are going to converge, and they're going to converge in two ways. One way is you're going to see folks like PayPal and Square and others coming into the crypto ecosystem. The other thing that you're going to see is companies like Coinbase and Binance and BlockFi and others going after, parts of the traditional fintech company business. And then ultimately you're going to have banks maybe one day getting involved somehow. But banks get their butts kicked by payment companies and fintech companies anyways. Like Visa is larger than any bank in terms of their market capitalization. And interestingly, Visa is heavily leaning into what's happening in crypto. So we'll see what happens with banks, but I think all these worlds are going to converge, and I think the crypto side is going to win. So I think you're probably going to have that account where you can do all of those things that you said, Peter. I think it's more likely that account is somewhere like BlockFi, certainly than a traditional bank, but also I think it's more likely that it's with a company like BlockFi, more likely with a company like BlockFi than with a traditional company like TransferWise.
Yeah, it certainly feels like banks are having their blockbuster moment. When I got my letter from Lloyd saying they were closing my account in 65 days, I phoned them up and said, look, I just need to know why I've been with you for 25 years. And they said, oh, you have to come in for an appointment. So I had to go to a branch. And okay. I walked in, I just thought, God, this is the first time I've been in. I couldn't even remember, maybe 3 years, because I have no need. And then I waited half an hour for an appointment. And in that appointment, I was told, well, we can't tell you why, because the department who closes accounts down never give a reason, but you have essentially, like 50 days left. And I was like, oh, okay. Well, I can see where your business model is going. The asset of having something on the high street in every town is now a liability, and your customers will migrate away. But the one advantage they have, like out in the US, you have the FDIC insurance. We have our accounts here in the UK. I think they're insured up to £75,000 by the government. Are insurance services coming to companies that custody Bitcoin? I know Gemini has some form of insurance. I know, I'm pretty sure you told me you looked at it before, but it was way too expensive before. Is this stuff coming?
Yeah, it's definitely coming. I think it's coming for the custody side of things. It's already here in some capacity for the custody side of things. There'll probably be eventually maybe some kind of insurance for the earning interest side of things, but definitely for the custody side of things. And this has to be the last question because unfortunately I have to jump. But one thing I would highlight is that, look, FDIC insurance and the insurance that you have, Peter, is cool. But Bitcoiners are going to be so rich, it's an insignificant amount of money for them, man. Like, what did you say? It was £75,000 in the UK? Like, you're going to make so much money off your Bitcoin that you're not going to give a flip about £75,000 worth of insurance. You're going to want to use whatever's best for your life as long as... how frequently has the UK had to use this insurance scheme recently? Like
2008 was when I think it was born out of 2008. The risk in 2008, but yeah, I mean, I think it's just one of the things some people think about when So, for example, say you were paying 6% interest, but it was like you could pay 4% interest and be insured. It might be one of those things that people will take that trade off.
Yeah, absolutely. And right now, we're always looking at that. Right now, the price of insurance for a custody account, there's a couple companies doing this, is like north of 2%. Like I saw a pricing sheet recently, and it was 3% a year to insure your crypto against like cyber theft if it was just sitting in like a normal custody account at Gemini. So forget even earning yield. So the underwriting cost, when you say, I want you to not only underwrite the custody, but also the lending activities, now the cost is going to go up. And ultimately, every time we've looked into it with anyone legitimate that could actually, support billions of dollars in insurance coverage, they either say we can't do it or oh golly, it's going to cost you, 25% a year. And then it's like, well, that ruins the economics for
Yeah,
everyone.
yeah. Well, listen, Zach, look, appreciate you doing all this. I was going to cover one last section with regards to how I think the market's changing. Like, people don't need to sell their Bitcoin because of companies like you, but let's do that next time. Let's talk about the future of banking next time. Hopefully in person, hopefully in New York. Hopefully we'll grab a steak somewhere and have a proper catch up. Ben, appreciate you coming on and helping with this one. Appreciate all your work you've done supporting the show, Zach. I'm glad to see the company flying. Say hello to Flory for me, and yeah, just hope I see you soon.
Great to see you. I'm still a huge fan of what Bitcoin did. We're so pumped to have the opportunity to continue to be sponsors, and I miss you, Peter, and Ben. Congrats on joining the team, man. We'll talk again soon, guys.
Thanks.
All right, bro. Take care.